Here's something strange that has been happening, and almost nobody is talking about it. While every headline on your screen has been screaming about artificial intelligence, while everyone has been pouring money into tech stocks, the most powerful financial institutions on the entire planet have been quietly doing the opposite. They have been buying gold. And not a little bit of gold, record breaking amounts of it. So today we are going to unpack one of the biggest disconnects in the financial world right now, why the smart money is loading up on a 5,000-year-old rock, while regular investors are being sold the future, and more importantly, what it actually means for you and your money. Stick around to the end because the real lesson here is not the one you are expecting. Let's start with the gold story because the numbers are honestly hard to believe. At the start of last year, gold was trading at around $2,700 an ounce. By January of this year, it had nearly doubled, smashing through $5,400 an ounce and briefly touching an all-time high near $5,600. In the world of safe, boring assets, that kind of move is almost unheard of. Gold is supposed to be the thing that sits quietly in a vault. It is not supposed to double in a year. So, who was doing all this buying? Here's the part that matters. It was not your neighbor. It was central banks, the national banks of countries all over the world. According to the World Gold Council, central banks bought hundreds of tons of gold in just the first few months of this year alone, and they're on track to buy somewhere between 750 and 850 tons for the full year. To put that in perspective, that is roughly double the pace they were buying at for most of the last decade. And it is not just one or two countries. Poland has been one of the biggest buyers, adding to reserves aggressively. China has been steadily accumulating. Kazakhstan, Uzbekistan, India, and a long list of emerging market nations have all been quietly increasing their stockpiles. In fact, a recent survey found that 43% of central banks plan to increase their gold holdings this year. That is up from less than 30% just 2 years ago. Now here's the question you should be asking. Why? Why are the most sophisticated financial players in the world buying a metal that pays no interest, generates no income, and just sits there? 3 reasons. The first is diversification away from the US dollar. For decades, countries held most of their reserves in dollars in US government bonds. But with rising government debt and growing geopolitical tension, a lot of nations are quietly hedging their bets. Gold is something nobody else controls. It cannot be printed, frozen, or sanctioned. When trust between countries gets shaky, gold becomes the neutral money everyone still accepts. The second reason is inflation. When you're worried that the purchasing power of paper currency might erode over time, gold has historically been a way to preserve value. It is not perfect, and it does not always work in the short term, but over very long stretches of history, it has held its ground. And the third reason is the most interesting one for our story today. It is fear, specifically fear about how expensive everything else has gotten. And that brings us to the other side of this coin, the AI side. Because while the central banks were buying gold, where was everyone else putting their money? Into technology, into artificial intelligence, into a handful of giant companies that have come to dominate the entire stock market. And look, the excitement is not crazy. Artificial intelligence is a genuinely transformative technology. Some analysts believe it could add trillions of dollars to the global economy over the next several years. The companies building the chips and the data centers behind it have seen their stock prices rise by hundreds, in some cases over 1,000%, in just the last few years. But here's where it gets uncomfortable. A growing number of serious people are starting to use a word that makes investors nervous: bubble. One chief economist at a major investment firm recently warned that the 10 largest companies in the S&P 500 today are actually more overvalued than the biggest companies were during the dot-com bubble of the late 1990s. Think about that for a second. We all know how the dot-com bubble ended, and he's arguing that today's concentration at the top is even more extreme. There was also a moment earlier this year that gave everyone a real scare. A lesser-known competitor released an AI model that performed nearly as well as the expensive American ones, but was reportedly trained at a fraction of the cost. In a single day, the market wiped roughly $600 billion off the value of the largest AI chip company. $600 billion in one day. It was the biggest single-day loss for any public company in history. The stock recovered, but the message was loud and clear. These valuations are fragile. They are built on the assumption that growth will continue forever, at full speed, with no surprises. And markets do not work like that. So now you can see the full picture. On one side, you have the institutions, the central banks, the people with the most information and the most to lose, quietly moving money into a defensive, boring, time-tested asset. And on the other side, you have the headlines, the influencers, and the hype machine, pushing regular investors deeper and deeper into the most expensive, most crowded trade on earth. That is the phrase that sums it up. They're buying gold and they are selling you the AI dream. Now, I want to be very careful here because this is where a lot of finance channels go wrong. I'm not telling you that AI is a scam. It is not. I'm not telling you to sell all your stocks and dump everything into gold. Please do not do that. That would be replacing one extreme with another, and that is not investing. That is gambling. What I'm asking you to do is something much more valuable. I'm asking you to notice the pattern and to think about what it means for your own situation. Because here's the uncomfortable truth about how money works. When everyone is rushing into the same thing at the same time, prices get pushed far above what the thing is actually worth. And the people who get hurt the most are usually the ones who showed up last, bought at the top, and were promised it would only go higher. The wealthy and the institutions are not smarter than you. They just tend to be earlier, calmer, and more diversified. And those three things, earlier, calmer, and more diversified, are something you can copy without any special access or insider knowledge. So let's talk about what that actually looks like in practice. Here are the principles that matter, no matter what gold or AI does next. Principle number 1, diversification is not exciting, but it is how you survive. The whole reason this gold story matters is that the smart money does not bet everything on one outcome. They spread their money across different types of assets that behave differently. Stocks, bonds, real estate, cash, and yes, sometimes a small slice of something like gold. The goal is simple. When one part of your portfolio is having a terrible year, another part can hold steady. If your entire net worth is sitting in tech stocks right now, you are not investing. You are making a single, enormous bet. Principle number 2, your time horizon changes everything. If you are young and you will not touch this money for 30 years, short-term swings in the market matter far less. You have time to ride out a crash and keep buying on the way down. But if you need that money in the next 2 or 3 years, that's exactly when overpaying for hype can really hurt you. Always match your investments to when you actually need the cash. Principle number 3, do not try to time the top. People have been predicting the AI bubble would pop for years now, and the market kept climbing. Likewise, gold could keep rising, or it could correct sharply. In fact, after hitting that record high earlier this year, gold did pull back hard for a stretch, and nobody can reliably call the exact top or bottom. The most powerful tool you have as a regular investor is not prediction, it is consistency. Investing a fixed amount on a regular schedule, month after month, smooths out the highs and the lows and takes the emotion out of it. Principle number 4, take care of the basics before you chase anything. Before you put a single dollar into gold or AI or anything else, make sure you have an emergency fund of a few months of expenses, and make sure you are not carrying high interest debt. Paying off a credit card charging you 20-something% is a guaranteed return that no investment can promise. Now, some of you are still going to ask the obvious question, should I own any gold at all? And the honest answer is, it depends on you, but here's how thoughtful investors generally think about it. Gold is not the main course. It is more like insurance. Most financial planners who recommend it at all suggest keeping it to a small portion of a portfolio, often somewhere in the range of 5 to 10%, as a hedge against the unexpected. The idea is not to get rich from gold. The idea is to own something that tends to hold up when everything else is falling apart. If you did decide you wanted exposure, you would generally have a few options. You could buy physical gold, like coins or bars, though that comes with storage and security headaches. You could buy a gold ETF, which is a fund that trades like a stock and tracks the price of gold without you ever holding the metal. Or some people get exposure through the companies that mine gold, though those behave more like stocks than like the metal itself. Each one has trade-offs and none of them are a magic button. But I want to bring this all the way back to the real lesson because it is bigger than gold and it is bigger than AI. The real lesson is this: pay attention to what wealthy, informed people do, not just what they say. The financial media makes its money from excitement, from the next big thing, from the story that makes you feel like you are about to miss out forever. But the people who actually build and keep wealth are usually doing something far less thrilling. They are diversifying, they are managing risk, they are thinking in decades, not days. And every so often, they are quietly stepping back from the crowd while everyone else rushes in. You do not need to predict whether the AI bubble pops next month or next year. You do not need to guess the price of gold. You just need to stop being the last person to the party, holding the most expensive ticket, be earlier, be calmer, be diversified. That is the entire game. So here's what I want you to do after this video. Take 10 minutes and actually look at your own money. Ask yourself one simple question. If the most crowded trade in the market had a really bad year, how badly would it hurt me? If the answer scares you, that is not a reason to panic. It is a reason to calmly start spreading things out. If this helped you see the bigger picture, do me a favor and subscribe, because this channel is all about helping everyday people think like the wealthy actually think, not like the headlines want you to. Building real net worth is not about chasing the hot thing. It is about playing a smarter game than everyone around you. And one last thing, just so we are crystal clear, I am not a financial advisor, and nothing in this video is personalized financial advice. This is educational content to help you ask better questions. Always do your own research, and when in doubt, talk to a qualified professional who knows your specific situation. Thanks for watching. I'll see you in the next one. Let's build